We'll just give it one more minute for some additional people to join the webinar, and then we'll get started. Okay, welcome to this webinar titled Basel Endgame, Shaping Financial Regulation in the Trump 2.0 Era. Today we're joined with two special guests, Douglas Elliott, as well as Bill Coen. Welcome to you both.
Thank you.
Thank you.
For the viewers who aren't aware, Doug is a partner at Oliver Wyman in New York, where he focuses on financial regulation and associated public policy issues and their implications for the financial sector. He analyzes a wide range of issues and has published papers on a diverse range of topics, such as financial institutions in the age of populism, data rights in finance, and tackling global market fragmentation in banking. He has also testified multiple times before both houses of Congress and participated in numerous speaking engagements, as well as appearing widely in the major media outlets. The New York Times has described his analysis as refreshingly understandable and without a hint of dogma or advocacy. Thanks again, Doug, for joining us.
Thank you.
Bill has served as the Secretary General of the Basel Committee on Banking Supervision from 2014 to 2019. For over 2 decades, Bill has been intimately involved with increasing the safety and soundness of the global financial system. Currently, he serves on boards of various organizations and acts as a key advisor to Suede, MUFG, Buna, China Construction Bank, and others, and also serves as an advisor to KPMG. Thanks again, Bill, for joining us.
Thank you, James.
Just to set the scene, so for this webinar, we'll be talking about Donald Trump. He'll be inaugurated as the 47th President of the United States on January 20th, 2025. He's made it known that deregulation will be a cornerstone of his second presidency. And some of the key financial regulatory roles that Trump will look to appoint are, of course, the Securities and Exchange Commission chair. Trump's already indicated that he wants Paul Atkins, a previous SEC commissioner and current CEO of Patamac Global Partners, to fill the role. The Commodity Futures Trading Commission chair, the Consumer Finance Protection Bureau Director, Acting Comptroller of the Currency, and the Federal Deposit Insurance Corporation chair. With some successful political moves, Trump could control a large portion of bank rulemaking, with the FED, FDIC, and OCC focusing on capital and other prudential requirements, while the CFPB focuses on consumer protection. Although Trump 1.0 sought to deregulate, his presidency probably saw limited success in deregulating in the financial sector, although one of the more significant regulatory changes from his first presidential term could be considered a slight weakening of the Volcker Rule. In 2018, Trump signed the Growth, Regulatory Relief, and Consumer Protection Act into law, which raised the threshold for increasing regulation for bank holding companies from $50 billion to $250 billion. So to kick things off, Doug, what do you think Trump's immediate priorities will be after entering office?
Yeah, thank you very much, James. I'd make 2 high-level points before going into a little more detail. One, I really do believe that we're likely to see substantially more financial deregulation under Trump 2.0 than under Trump 1.0. There were some special circumstances under 1.0 that I could come back to, but in particular, Trump is more focused on his legacy this time around. He also now has the experience of being president for 4 years and adds 4 years in between to think about things. He's established a team around him that he trusts. He's in a better position to push things forward. And I think we're all aware that Trump cannot reasonably be described as a policy wonk. But there are maybe 5 policy areas where he has deep feelings consistently throughout his career. And one of those is deregulation. So I think the chances, as he looks at his legacy, as he and his team certainly feel they have a big mandate for change coming out of this election, the chances that this wouldn't be in finance as well as other sectors, I think are pretty low. So I think you'll see that. Second high level point I'd make as background, there are also a lot of indications that the Trump team wants to have significantly more coordinating control over the independent regulators than we've seen historically. Regulators have never been entirely independent, and when you look at the legal basis for the independence they do have, there is certainly room for a president to push considerably further, and it does look like that is their intent. And so to go to your actual question, what would we expect to see early on? I'd say there are several things. One, he's already made clear that he's going to remove the 5 top existing financial regulators to the extent he can immediately. 4 of those 5, that's a certainty will happen. There's a question on the Fed Vice Chair for Supervision, Michael Barr, where he doesn't look like he'll go voluntarily, and he has some significant legal protection. So we'd have to see what happens there. But certainly there's no better way to send the message that you're in charge than by firing the existing people, with the implication you could certainly fire their successors if need be. This also clears away the existing regulators to allow the new appointments to start acting as quickly as they can get Senate confirmation. So I think you will see a lot early on. One of the things you'll see is reversal of a number of the more recent things that have been done under the Biden administration with which the new team disagrees. So in particular, the Community Reinvestment Act, the revisions that were made to that are already under a strong challenge by litigation and run against the beliefs of the new team as what the appropriate policy are. Merger guidance that the FDIC and OCC have provided, which were viewed as making it difficult to have regional bank mergers, those will be reversed quickly. The Consumer Financial Protection Bureau has put out implementing rules for 2 sections in Dodd-Frank recently, 1033, which is kind of open banking, and 1071, which is a bunch of additional data provision requirements for small business lending. Both of those the banks hate, and I think will be reversed quite quickly. So I think you'll see those things, and I'm sure we'll come back to the Basel III Endgame itself, which I have strong views about what's likely to happen there.
Excellent. Bill, anything to add on that, maybe around replacement of regulators or additional policies that you think might be rolled back?
Yeah, James, thanks. The expression, we've heard this quite often since the election, personnel is policy. That's absolutely right, and I agree with everything that Doug has said so far. I have been surprised that the amount of chatter in the media about possibly replacing Trump, forcing Powell out. That is so unlikely to happen. I think it would disrupt markets. It would not be received well, and I think Trump has now already said like he's not really interested in going down that road. It's probably not legal anyway. You would have to be removed for cause. But as Doug pointed out, the case for replacing Vice Chair Barr as the Vice Chair for Supervision, that's less clear. That's a relatively new role at the Federal Reserve. So Vice Chair Barr could remain governor of the Federal Reserve, not as Vice Chair of Supervision. That's an interesting case. It will be very interesting to watch that and see what happens. I've seen some names that have been bandied about regarding possible replacement. So that will be interesting to watch. When it comes to the FDIC and OCC, it's clear. There will be, Marty Gruenberg of the FDIC has already announced he's leaving, stepping down. he's the acting chair of the FDIC. He's leaving 19th of January. So that's an opportunity for Trump to appoint a successor. Same with the OCC, the Mike Sue of the acting comptroller. I've heard various names for both of those positions, so that will certainly be positions that Trump will replace. The CFPB chair, this is really interesting, and Doug has already touched on the role of the Community Reinvestment Act, the CRA. I think this one of the big effects we're going to see, and we can turn to this in a little bit. I think one of the big effects of the incoming administration will be on M&A activity, mergers and acquisitions, because that has pretty much stalled because of objections by the FDIC and the CFPB, objections to banks' performance when it comes to community reinvestment. With changes at the top within those two organizations, I really do suspect that will pretty much open the spigots for a lot of pent-up demand for M&A activity. But that's James. That's all I've got to say. I'll leave it at that.
Excellent. Thanks for that. And I think there's probably a good point there around where in Trump's first presidency, I think he was quite fond of appointing people into acting positions rather than waiting for confirmation to try and get things moving quite quickly. So it'll be interesting to see if he takes the same tactic again this time around as well. Back to you again then, Doug. What sort of strategic focus, you've mentioned Endgame already, will Trump kind of start to look to take more longer term throughout his presidency?
Yeah, well, look, first of all, as we've kind of implied, almost no U.S. president actually cares directly about financial regulation. Obama did because he was in the global financial crisis. FDR did because of the Great Depression and the banking crisis. Frankly, almost no sane person pays attention to financial regulation unless they're directly affected by it or it's their profession. So it's not that I anticipate Trump to be getting down into, hey, how do we handle the Basel III Endgame and, et cetera, et cetera. It's rather that he will set a broader tone of let's get the government out of the way of sensible business decisions, looking for deregulation in order to spur growth. Certainly, there's a feeling that when the Democrats were in charge, including in financial regulation, that they went way overboard on putting in requirements. So I think what you'll get from the tone from the top is at that level. And then, as Bill was saying, a lot of this will be about the personnel themselves and what they focus on. But we do know, based on the philosophies of the people who are almost certain to be appointed, that by which I mean, in many cases, we have a very strong sense of who's going to be appointed. There's always a room for surprises. I don't know anybody who thought Janet Yellen was going to be Treasury Secretary until it was announced or very close. So even someone more predictable like Biden can surprise you. But for example, the strong consensus is that Travis Hill, vice chair of the FDIC, will become the chair. Mickey Bowman at the Fed is in very good shape to potentially replace Michael Barr, though she's certainly not the only name for that. So we have some sense of the specific people, but even more than that, it's clear there are certain approaches, philosophies and approaches that people will have to take if they want to be appointed by this administration into these positions. And so you're going to see, as I was saying, an approach that says, let's start with the assumption that businesses know what they're doing. Let's not, for example, one of the complaints many banks and many Republicans have made about the regulators, supervisors in particular in recent years, is that they're essentially bad management consultants. That much of what they've been doing is telling banks that they, the supervisors, know better than the banks what their situation is and how they should behave. And so I think there will attempt to be a move away from that So some of that would, as we were just touching on, would be on the bank M&A, where I think that the Democratic appointees were a little bit like King Canute, ordering the tide not to go out. There are economic forces going to push towards consolidation among the regional banks. I think that would have happened even if Harris had won. But now that pent-up economic pressure, I think will come through, as Bill was saying, a lot faster. So things like that, let the business decisions be made by the banks themselves. I think you'll also see, as a longer term strategic approach, lower capital requirements. There's kind of a direct trade-off. And by the way, I was a visiting scholar at the IMF for a couple of years and focused on societally optimal capital levels. So I'm very familiar with the academic and public sector analyses on this. There's a fairly wide range of results as to what the right level is, but one of the things pretty much everybody can agree on is that you can run the financial sector hotter for a period of time if there are lower capital requirements. Now, running it hotter somewhat increases financial stability risks, so you're trying to find the right trade-off between the two. But it's clear that this is an area where the Democrats and Republicans just have a big philosophical difference about financial regulation. So I think you'll see, probably a reduction in equity to RWA ratios in terms of requirements anyway, of 1 or 2 percentage points, which is reasonably sizable. It's not game changing, but that should free up the banks to take on more activity, take some market share back from the NBFIs, probably, the non-bank financial institutions. I also think along the same lines that the enhanced supplementary leverage ratio that applies to the largest of the banks will probably either be abolished as a separate category or brought down from 5 to 4%. But I think a lot of what you'll see is on the capital side. As I'm sure we'll come back to, supervision's a lot tougher to change, but I'll leave that for further discussion.
Bill, you got anything you'd like to input there apart from the professional hurt about presidents not caring much about financial regulation?
I would say, Doug and I go way back. I've known Doug when he was at the, before Oliver Wyman, before even you did some work for the IMF, Doug, and I'm shocked by your rash assertion that no one is interested in financial regulation other than those who are within it. I guess that is true. But yes, it's a hurtful suggestion. I think in the short term, I mean, the only thing I would add, I think Doug's, and I've always agreed with Doug's very thoughtful, thorough analyses. This question of now we could spend hours on a webinar or a conference talking about the optimal level of capital. The thing it's always confounded me somewhat. U.S. banks are demonstrably higher capital levels than their peers around the world. And yeah, maybe there's scope to reduce the gold plating that kind of characterizes the U.S. system, but they're not. This whole idea that the banks will have more capacity to lend. It doesn't seem to be. It's a competitive space. Doug has mentioned the NBFIs, the non-banking financial institutions. Capital doesn't strike me as a constraint. U.S. banks, for the big banks, for the G-SIBs, the global systemically important banks, their leverage ratios, last time I checked, I think they cluster in the 6% range. I mean, clearly they're not brushing up against the minimum requirement like a lot of the big European banks are. I think even some of the British banks are closer to the leverage ratio minimum requirement. Regulation is not. It really has never been a constraint for lending in most jurisdictions. Yeah, the ability to pay out dividends and other capital distributions, I think that's what drives the capital levels in the US. I don't think it's so much, there's so much more scope to lend if the capital requirements are reduced. But as I said, that's a that's really a discussion for another day. Doug mentioned, and again, this is an interesting discussion. What will be the short-term impact? People like to say regulation, but you have to distinguish between regulation and supervision. Doug's already made that distinction. It's an important one, though. When it comes to regulation, yeah, that's a Basel III thing. Supervision, and there wasn't really so much of that during Trump 1.0. There wasn't really so much deregulation. The supervisors in the U.S. told me that's not what they really were focused on. What they really were concerned about is taking too heavy of a hand when it comes to supervision. There's not a supervisor in the world, particularly here in the U.S., who wants to wake up some morning and see that President Trump has tweeted or has put something on his his social media platform complaining about a supervisor. You don't want to be the subject of a Trump tweet. So supervision really kind of, supervisors kept their heads below the firing line. Now that's a little bit difficult to do because of what happened last year with Silicon Valley Bank, First Republic, and others. So there's this contrast. There's a bit of a bit of tension between taking too heavy of a hand on the supervisory side versus what will likely be from the top of the organization, this deregulatory push, or let the capital markets decide, let the banks kind of do what they want, but from the supervisory side, don't take too heavy of a hand. So it'll be interesting to see how that tension plays out.
Yeah, and I might add, if I may, James, I think there are at least two significant constraints on how far this deregulatory push can go. One is the supervision that we're talking about, and I'll say a little bit more on that in a second. But the other is, I think it's going to be extremely hard to get legislation through about financial regulation. There are very thin majorities in both House and a relatively thin majority in the Senate for the Republicans. The Democrats, rightly or wrongly, are convinced that whenever the subject is financial regulation, they win votes by fighting the Republicans on it. And since the Senate seems virtually certain to keep the filibuster for legislation, so that with a few exceptions, you can't get legislation through if you don't have 60 votes. That means you'd have to flip 7 Democrats in addition to the 53 Republicans on an issue that the Democrats are convinced they win on. So I mention that because a fair amount of what regulation does is the direct mandate from these laws. And so even if you have a change of personnel, as we will, they're still legally bound to have regulation to follow through on these things. And Dodd-Frank in particular got quite prescriptive about a lot of that. Gave significantly less leeway to the regulators than historically legislation had done in the US. Just talking about, I should say the one exception is crypto. Crypto won the election. They're going to get legislation that they want, and we can come back to that. On supervision, I would just say, I think here Bill and I may have somewhat different views, and it may be I hang out with bankers too much, in addition to the time I do spend with officials. But I know that in Trump 1.0, I constantly heard from banks in settings in which they had no reason to be anything but candid. So this wasn't them presenting to the world, but just me talking with them. I repeatedly heard from them, they'd felt there actually had been very little change in supervisory behavior as a result of the changes that were intended in supervisory culture when the first Trump administration was in place. So I do think there is some real question. I mean, look, if you're a supervisor, your incentives are to be conservative. That's probably also your mindset anyway, if this was what you chose to do professionally. But if you are too conservative, not much bad happens to you. If you're too flexible, if you're flexible, you're not going to get credit if that helps the economy grow and didn't produce anything bad. You're certainly going to get blamed if it turns out, you were supervising SVB and they blew up. So I do think there are real questions as to how far supervisory culture and behavior can be changed.
Excellent. Thanks for that, both of you. Now, I know we've been dancing around the topic a little bit here. Basel Endgame. Where do you think this lands from a Trump administration perspective?
Sure. If you don't mind me talking a little too much here, Bill, I know I've been crowding you out a bit, but since I've been fairly specific about what I think will happen, why don't I do that, and then you can give your view. I have what might be a bad habit, but I like to think is useful. I have a habit of quantifying my intuitions, so you have a sense of what I actually mean. And what I've been saying is, I think there's about a 2 in 3 chance that we get the Basel III Endgame finalized under this administration, this coming one. Probably I should revise that up a bit from 2/3, even a bit higher based on things I've been hearing recently. Now, two things about that. One is it's only going to happen if it's viewed as largely capital neutral, which might still mean a few percentage points aggregate increase, on average. If it's paired with a number of other actions that I expect that will more than counter that increase so that there's still a net reduction in capital requirements. And it's going to be slow. I think the earliest we could conceivably have finalization would be the end of next year, and much more likely. Well, I've been telling people if we're going to start a betting pool, I'm on May 2026. But so this could be well off because you're going to have the new people come in. You're going to have them figure out what they think. You're going to have them negotiate among themselves, all these new folks. Then they're going to have all the technical work done. Then they're going to have to put it out for notice and comment. They're going to have to think about the comments, see what further revisions. It's just in the US a very long process if you do it right. And implementation, I think, wouldn't probably start till January 2028. And as you know, pieces of it are phased in, though a lot of it does start immediately at that point. I'd say there are three things that could put me in the 1 in 3 or a little bit less probability where it doesn't happen. The first, I think, is at this point very low likelihood. That would be if the new team is just so America first, they decide they don't care what was said in Basel. They're going to do their own thing. The announcements of Besant and Kevin Hassett at the NEC, I think, make this a really low probability. Second would be we have less sense of who the comptroller of the currency will be than we do the other positions. There's an outside chance somebody's chosen who just doesn't like the Basel III Endgame. And I don't think the rest of the players feel so strongly about this that they would bulldoze the comptroller if they really don't like this. But the most likely, if this doesn't happen, would be if the industry comes down against it. And that's why in the last week, I've had indications it's probably even more likely than 2 in 3 this happens. One, on Thursday, the CEOs of the GSIBs got together at a trade association meeting. I'm told 6 of the 7 were in favor of Basel III Endgame on a capital neutral basis. Wednesday of last week, I spoke at a similar situation to this, but in person. I spoke for about an hour and a half with 10 of the regional bank CFOs, and they're remarkably unfussed about Basel III. Basically, they think they'll be excluded from a lot of the effects, and some of the effects are positive for them anyway because they don't do so much market risk stuff, and they have a lot of traditional lending, some of which would see risk weights go down. So anyway, sorry for the long monologue, but just wanted to set the stage there.
Doug, I think that was a good analysis. I do like your your propensity to quantify your intuitions. It's well put. I would, if I were to do the same. I mean, I've been very, maybe not surprisingly, given my previous role with Basel III, but I have been all along quite optimistic, because it's always been about calibration. You know, there are different things the industry weighs in on, the structure, you know, the actual details, but that's been, you know, for FRTB, for example, there were 10 years of consultation with the industry, in close consultation, several instances. From a design perspective, the industry knows what it's getting, and in fact has had a significant hand in helping shape the design of FRTB, which I just use as an example, but it's also true with the other, you know, the standardized approach for credit risk, operational risk, and so forth. So the design really is not in question. The timing is also something that the industry likes to weigh in on, and one of the favorite tactics is to delay. I think you're probably right. I'm tempted to say the end of the year, of the end of 2025, but I think you're right. With the changes at the top of the organizations, got to get those people some time to get their feet under the desk. And probably most of them are already familiar with the discussions. I agree. Travis Hill, the current vice chair of the FDIC, I've seen his name. I know Travis a little bit. I suspect he will ascend to the chairmanship. I've heard different names of the OCC, including Yelena McWilliams, the former head of the FDIC. She is definitely familiar with Basel III. So the timing, I think, is definitely in question. You're probably right about a 2028 implementation. So that's I mentioned design, timing, but the main thing is calibration. That's really what the banks are interested in. That's the main thing. 99% of this debate is about calibration. I always question, you know, the banks have done very well to say, and the media has picked up on this. The latest proposal from the US is that there'd be a 19% increase. But that's not really the way it works. That's the 19% aggregate increase across the sample of banks that participated in the US quantitative impact study. We know that there are some outliers. You know, we've got 2 banks in the US that have very large, relatively speaking, very large trading books. Surely those had to have skewed that 19% aggregate increase. We've got other banks that have a more, you know, let's call it a conventional or traditional balance sheet structure. And on the credit risk side, those banks are not going to have a large impact. So Doug, to say that the banks would be content with a neutral capital impact, undoubtedly it's going to raise for some banks, those banks that have got a large market risk exposure. I suspect the banks know that. They know, the supervisors know that. So, you know, there'll still be some debate around the calibration. But I do suspect it will come down. The latest, the notice of proposed rulemaking that was published in the middle of last year, that resulted in an aggregate increase of 19%. Then there were some tweaks made. That aggregate increase was then 9%. There'll probably still be some lobbying. There'll still be some debate within the agencies. So I'm far more hopeful that it will get done. Why am I optimistic? Because what we're left with, what's in place right now, was never thought to be considered permanent. Doug mentioned the America First perspective. I don't think, and I saw this firsthand when I dealt with the officials, both at the Basel Committee level and the governing body, which is, you know, the central bank governors and heads of supervision. I've seen this firsthand. All policymakers are worried about having a safe, sound, resilient banking system domestically. I could tell you, though, that's also important internationally. I mean, the U.S. is, of the 29 G-SIBs, the U.S. has 7 G-SIBs. you could bet your life that that policymakers here are concerned about having safe, sound, resilient systems in the UK, in Europe, all over the world, because our banks in the US are doing business there. We want strong markets. It's, it's an interconnected, it's a global banking system. And you can't just take an isolationist approach and say, we don't care what happens outside the US. Our banks make money, they operate, they've got a lot of operations outside the US. We've got banks overseas that have a very large presence domestically here in the US. You want those banks to be held to a high standard. So again, it's all about calibration. Whether or not the US continues to gold plate is another matter. They are still comfortably above Basel standards. Will they bring it closer to the Basel minimum standards? I suspect so. Will they still gold plate? I suspect so. One last thing, as Doug said, to paraphrase what Doug said, when it comes to passing some kind of financial regulation, some kind of legislation, you talk about capital. Well, there's political capital. I don't think the Trump administration, I'm sure the Trump administration does not view this as something on which to spend political capital. What's the problem you're trying to solve? The banks here in the US are profitable. We had that disruption last year that caused some market distress. But by and large, the US banking system is pretty healthy. There's not so again, what's the problem you're trying to solve? I do think that a deal will be struck, that Basel III will get finished. And I agree with Doug's timeline, probably middle of 26 with implementation in 2028.
Excellent. So one final question then, maybe in the last 5 minutes. So are there any other kind of potential longer term impacts that Trump will look at from a deregulation perspective? And kind of how does he structure or manage that balance between, kind of as you mentioned before, Doug, the international versus the domestic?
Bill, I'll let you take the first shot at that.
Yeah, I mean, I go back to well, I won't say more about regulation, financial regulation, other than Basel III. I think that'll get done. That probably is not legislation. That's more regulation. Just to remind people, as you all, people listening to this webinar, as you probably know, there's legislation like the Dodd-Frank Act. That was legislation that was approved by both houses of Congress. Then there's regulation. And that's something that the agencies, the Fed, the FDIC, the OCC, that's something that they've had authority delegated to them by Congress to write this legislation, as long as they follow the Administrative Procedures Act and certain other dimensions like consulting, publicly consulting. There are rules that the agencies have to follow, but they don't go through Congress. Unlike, it's more of a legislative process in the European Union. So again, I think Basel III will get done. That doesn't require legislation. That's a regulatory process. Doug is spot on when it comes to crypto. There will be guardrails put around crypto, and that's what those involved in the crypto industry, they've been calling for this for some time. I think that's a good idea. There are no guardrails, so to speak, at the moment, and having something with probably a light touch that's favorable to the crypto industry. I think that's definitely going to happen. Same thing with artificial intelligence, the use of AI. That industry, for good reason, has called for some kind of official sector guardrail, some kind of a framework that the users of AI, that they know what to expect from an official sector perspective. I think that's going to get done too. There's been demand for that for some time. So I think those are two areas. And sorry, Doug, I hope I'm not repeating too closely what you have already opined on, but I just happen to agree, crypto and AI. The last thing I'll say, James, is on supervision, but that's not a structural longer term thing. It's interesting. The people I spoke with when I was in my role in Basel, obviously the supervisory community, and in the U.S., I was with the Fed and the OCC long before I had joined. I'd gone to Basel, and it's interesting to hear that from their perspective, they felt that they were taking sort of a lighter hand than they normally would have, absent a Trump administration. Doug had heard from the industry that no, it doesn't seem like there was much of a let up at all. So I think it's just a difference of perspective. I don't suspect. I know right now there's quite a bit of once burned, twice shy kind of an attitude that the Fed, I think, really dropped the ball when it came to Silicon Valley Bank and some of the others. You don't want to be you don't want to be in that boat again a year later. People will really start asking questions if they haven't already. And what happens in the U.S. supervisory system really is carefully watched outside of U.S. borders. So I know there's not a supervisor in the world who wants to be put in that light, like as though they had the information, but they did nothing with it. So I suspect the level of supervision, of regulatory oversight, if you will remain unchanged.
Yeah, and then on the international side, just to complement what Bill was saying, one of the questions before the election, as we thought about if Trump wins, what would be the implications, was might the U.S. basically pull out of the Basel Committee, pull out of the Financial Stability Board, essentially as part of an America First approach, say, we don't need, especially since the banks have often presented what's come out of Basel as if there were no significant U.S. input, but this was just the rest of the world pushing things on us. There was a question as to whether sort of the mega types might want to pull the U.S. completely out. I think with the appointments of Bessent and Kevin Hassett and just sort of vibes we've gotten since then, this is unlikely. But I do think in practice what we will see is the U.S. staying in these organizations where they do have a lot of influence, but being an anchor that makes it difficult for the ships to go anywhere. I think that our international partners will probably be quite frustrated with the U.S., but I think the U.S. will be fairly effective in keeping them from doing too much more, except for purely technical things. There will be more technical issues that arise where it's clear to everybody it would be useful to have some standards, which won't be political, but anything that has significant effect on capital, for example, or on other key issues like treatment of crypto, I think it's going to be hard to get international consensus unless it happens to align with the U.S.
Excellent. Thank you both for your insights today. I think this has been a very interesting discussion, everything Trump and Endgame and everything in between. And hopefully our viewers have also enjoyed the discussion. So once again, thank you both.
Thank you. Appreciate it.
Thank you, James. Doug, thank you.
Thank you.